Hello, performance measurement and MA students. Today I'm going to discuss controllability accounting. The rationale behind this concept is that managers are only accountable for those costs and revenue centers which they are responsible for, rather than uncontrollable area of their responsibility. Because this concept is highly important if you talk about divisional performance, or if you talk about managers performance. So when we evaluate these two area, divisional performance or managers performance, so controllable figures and uncontrollable figures are highly important, because divisional performance is assessed through traceable figures which are under the control of head office, and assessing managers performance, we will use controllable figures because they are under the control of managers. So let's start this topic with the different cost centers. I have a cost center in front of me. The first definition is cost center. So managers are only responsible and accountable for cost only. And for this type of centers, like you can say typical examples include production managers, or purchasing managers, or any managers which have direct connection with the cost variances. So cost variances are a typical example of a cost center. And the second center, we have revenue centers. Managers are responsible and accountable for revenue only. So here, managers are only accountable for revenue maximization, and they are only accountable for this as well. So they are not accountable for costs. So typical example include sales manager. So he is accountable for sales rather than any other area of the business. And profit center. So it's highly important to recognize that profit center managers are responsible for both revenue and cost centers as well. And because as a good manager, if you want to increase your profit, so you must recognize the fact that if you want to increase the profit, so you must decrease operating expenses of your business as well. So minimization of cost and maximization of revenue or profit, you can say, is the responsibility of profit center managers. And the last, and it's highly important as well, investment center. And investment center is a center in which managers are responsible for decisions about cost and revenues and investment in the business. Like like managers have authority to invest in working capital or dispose of any existing assets as well. So it's highly recognized that it's highly important to recognize this fact that investment center managers have a higher authority in terms of investment in working capital, or disposing of any existing assets. So, and measures such as ROI and RI, residual income, and return on investment is the matrix through which we will be able to account investment center. And you will study this kind of ratios, ROI, return on investment, and residual income in detail. And it's highly important to uh, understand this concept of controllability accounting. So that's it uh, for for now, and we will discuss a metrics later in a second part. And please like and subscribe this video so that you will be able to get this kind of video again and again, and please press the bell icon and press the like button as well. Thank you.